All right, let's get situated. We are live. We are live. It is 6:29. Alexa, stop. It is 6:29. So what? We got 1 minute. Finna get started. Wait on my guests to come. Multi-vision, and we're gonna get started. We're going to break down today liabilities, how you can use liabilities not only just for investing, but for entrepreneurs and businesses as well. So Multivision is going to break that down for us and show us actually how to do that. So let me actually get started here. He's going to join here in a little bit. Man, today was actually a good day. Actually, the whole week has been good. So even though the market ended, I think today down like what 0.21%, but Tuesday was up, Wednesday was up. So I'm pretty sure those who have a strong portfolio, who've been investing for a while, I'm pretty sure their portfolios have performed quite well this week. I know personally mine have went up. And then today we did the excellent day trade in our day trading group. If you don't know, we have a day trading Patreon group for those who's interested in day trading, maybe whether as a primary income or a secondary income. So yeah, so one of the day trades we put off today was ABIO. They announced that they're working on the vaccine. They did something for the COVID-19 and it shot up like down there 400%. So man, it was just a good day to day trade. That was the best one today. It was actually like new members for the first time who've joined our Patreon group. 10, 15, 20% gains like easily. So and the thing about this, we still waiting on our multi-vision is this happens like every week. I don't think people realize that. I think most people kind of look at the news like here and there, and you hear like, oh, the stock market was up today, or the stock market was down today. And you're just like, if it was down, like you think everybody lost money, but that's not the case, So let's see. I might have to start over and actually send him an invitation. So let me send him an invitation. All right, 1 second. We're gonna get started, and I looked up your stocks. So you actually gave me some pretty easy ones, to be honest with you. I think you gave me. All right. Yeah, I just sent it to him. I think you gave me like RTX. There he is. There's right there. There. All right, let's go. He's joining right now. Yeah, you gave me Raytheon, and it should have clicked as soon as I seen it. I'm like, there he is. What's up, brother? How you doing?
What's up, man? How are you? Yeah, I was trying to find if you were on the live on my feed, but I kept refreshing, but it wasn't coming up.
Yeah, my bad. Like,
No, it's good.
yeah, I'm still working on it.
It's all good.
So, man, I'll just get started. Like you know how kind of like our introduction. Like, I found your page, and I'm just like scrolling through your page. I'm like, man, this some damn good content. Not only that, like your graphics. I'm like, man, these are some great graphics. And my background is, I used to be a manufacturing engineer, so I used to do automation. So
Okay.
when I see people break it down where people can understand, it's like, yeah, that's somebody I gotta follow because that's my mindset. Break it down so everyone can understand. And so it was only right, if I'm using your content, I was like, man, I gotta bring you on. So I
Yeah.
appreciate that, and I appreciate you the introduction to Miami Invest Club.
Yeah, for
That
sure. Yeah.
that was pretty cool too.
Yeah.
So so anyway, I'll just kind of tell them about my page. Basically, minority investor. I'm just helping people who's new to investing get started. If you don't know, investing is one of the best ways to kind of grow your wealth, whether it's for retirement. I know people who use it as a primary income. They day trade, secondary income, kind of like me. So I'm just trying to get people started. People think it's complicated, but it's not. I just kind of break it
Mhm.
down. And, I'm really tired of people struggling financially and just like, hey, you got to do something besides putting your money in the bank. So
Yep.
that's what I'm all about. And
Yeah.
yourself?
Yeah. For me, and what you mentioned about kind of breaking it down, I think is so important because, so my background is I work as an actuary in the insurance industry now, but actually I'm going to be leaving that, kind of to focus on my own business and my own brand. But yeah, to me, it's all about kind of simplifying technical concepts and just helping other people understand, like you said, like there's basic fundamentals when it comes to like the balance sheet, the income statement that people need to know, and not just for businesses, for themselves, right? Like we each have our own balance sheet, we each have our own income statement, but people don't they can't conceptualize it because they can't visualize it in their brain. So for me, the reason why I actually came to Instagram was to how can I kind of bridge that gap where I can show graphics, charts, different ways to kind of conceptualize a lot of these technical concepts for other people to understand better. But yeah, my background is I work as an actuary now. Done a bunch of different types of work. Really focused. It's in insurance, but a lot of stuff that I think is really relevant to like financial analysis. But yeah, I'm really interested in just like kind of starting businesses, running businesses, and kind of making them more profitable. So that's kind of my interest. But I think there's a big connection between understanding how small businesses work and also just analyzing company financials and whatnot.
So on my end, when it comes to investing, like I know some people do technical analysis, but some people prefer the old school fundamental. So when you're doing fundamental, you have to look at the income statement, the balance sheets, and cash flow statements. When I first started looking at it, I'm like, this way over my head. It's too much. But gradually, I'm starting to understand. If you understand that, then you're on the same level as Warren Buffett and all these
Yep.
other great investors. And so that's the benefits I see. What about you?
I completely agree. And the funny thing is, like, when it comes to investing, I'm lazy. I just put money in the index and I let it sit. But like to your point, I'm all about fundamental analysis because I think people get caught up in the idea of like trading versus investing. Again, Miami Investment Club Artem, he talked about it because people that do trading, that's just a very quick. You that's like a full-time job. You're spending 10, 12 hours doing research, finding out when stocks go up and down. But fundamental, the whole point is put in money in a good company that the future outlook is better than what it is today, and you just leave it. You leave it, hold it, and that's it. And then you take the money out when you want to retire. I think people get caught up in the idea of, oh, I want to invest to like make a quick buck, but between like the taxes and like all the different costs, it's like you're not going to make money if you try to like just try to be trading every other day. It doesn't really work like that.
Yeah, you trade for fun. Like if you want to,
Mm-hmm.
trade, trade it all you want. But I don't think most people know the easiest, most passive way to being a millionaire, just
Yeah.
guaranteed, is just put your money in there and wait.
Yep.
But it's boring. Like just wait. That's it. Like,
Yeah.
yeah, just wait. Like
and,
wait.
and I think that's people's biggest misconception about investing. They think it's this secret, sexy like thing because they look at like Amazon, Jeff Bezos, Tesla. But it's like the reality is like it's just like buy something boring, but that continues to grow. Like if you look at Warren Buffett, he invests in like Wrigley gum. Like who even talks about Wrigley gum? But to him, it's because it's something that in his mind is not going to go away, right? It's
Yep.
sustainable, and because the economy grows, the company grows with the economy, so the money goes up with it. So like to me, I'm all about fundamental investing because I'm the type where I like to understand like what are the basics of the business, and if the business is run well and effectively, then to me that's something that I know is going to last and not just be around just because of some trends or fads going on.
Yeah, some of the fundamental stuff is just, common sense. Like Walmart. You think
Yeah,
Walmart's gonna go out of business? Like no. So you should invest in them. Like
yeah,
Disney. Like Disney's not doing too good right now, but you think Disney's gonna go away? Like no.
yeah,
Fundamentally it's sound.
yeah.
So anyway, we got a whole bunch of stocks to review. I don't know where you want to get started. You want to get started on the first one?
Yeah, sure. Yep. Mm-hmm. Or actually, do you think it helps to do like kind of the basics of the balance sheet and then kind of go into the stocks, or vice versa?
No, that's a good idea. I skipped over that. That's why you're on the call. So yeah, I'll let you take care of that.
Okay. Yeah. So I did a post on the balance sheet earlier this week, and I've been doing focus on that first because when I think of the balance sheet, I think of it as kind of that's the financial health of a company, right? So like
Hmm.
there's two sides to the balance sheet, and I think most people know about assets. They hear assets all the time. I want to build wealth. I need to get more assets. But I think what people get confused is that like there's two sides to it, right? Like someone can have $1 million in assets but be poor, right? Because if the liability side, the other side of the balance sheet is 995,000, that person only has $5,000 of actual wealth, of actual net worth to their name, right? And that I think that's what happens with a lot of like athletes and some celebrities where because they don't manage their finances, they buy everything on debt, and because they're
Hmm.
buying everything on debt, yeah, they have a $100,000 car, $2 million house, all these things that they possess, but they don't really financially own it because the bank owns it. They borrowed money to buy and purchase things. And the thing is, once the cash flow stops coming in, then they're poor because they can't even be able to make the payments on the same liability that they have. And I think it's important to first understand ourselves as like a balance sheet first, because if you can understand yourself as a balance sheet, then you do the same thing with the company, right? If you look at a company that, let's say it's valued at $1 billion in assets, but then again
Yep.
it's like 900 million in liabilities, you start to think like, why do they have so much debt in order to run their business? Like, can they not generate enough cash to increase the equity in the business? Are people not really willing to invest in the company? So like, to me, I'm always thinking about like, what's the balance between, okay, what's the assets, but how do I finance? How do I kind of use money to build up those assets? And it's really on two ways: our liabilities or equity.
So when you say assets, liabilities, and equity, I know the definition, but like, what's the simplest breakdown of
Yeah.
what those mean?
So for me, and I know people usually use assets as like ownership, right? But I actually, when I say assets, I always say it's something that you possess, right? It's something that you have. The phone that we're using to record, my TV, my car. If you own a house, those are all assets, right? The thing that we possess under our name. But the liability is important because that's something that you owe to someone else because you borrowed money. Every time we swipe a credit card, we're buying something on debt because, yeah, we may not have the money up front, but we can just borrow the money from someone else and then pay them back with interest. To me, equity are the real thing that you own. So if I have a house and I put a down deposit on the house, that the amount that I put down, that's the actual equity I have in the house, and that's really what I own. The remaining piece is what I'm paying to the bank, and again, that's a liability that I'm paying over time. And the goal
Okay.
is really to kind of limit the debts to the point of, and I'm not saying like having like no debt is like the best thing, but I think people need to find a balance of what can I continue to manage with the money that I'm getting as income. Because I think what happens is that a lot of people will have assets, but the debt payments that they're making are greater than the actual income that they're bringing in. And when that happens, that's when it's a problem, because that means once the money stops coming in, then you're out of luck and you can lose. You start to lose the assets that you think you own, right? So that's kind of how I look at kind of the balance sheet, and again, just the relationship between like the assets on one side and then the liabilities and equity on the other side.
So basically, once we get this knowledge, people could kind of break down a company and know if the company's in trouble and like, man, should I put my money in or not? Like, you can
Exactly.
make a decision. Cool.
And and if you look at like the airline industry, right, the reason why
Oh,
they're in
yeah.
so much trouble now is because they have a lot of debt, because there's big airplanes, like they're very expensive, right? So they have to find funding from other sources to buy those airplanes. But what happens is, in the current like kind of economy we have right now, people aren't flying, so the revenues go down,
Nope.
meaning they don't have enough money to pay back the interest payments to the people that they borrowed money from. And then what happens is a cycle, right? You have rating agencies which rate different companies based off of their kind of portfolio, like the liability portfolio. Similar to us, where we have a credit score, companies have their own credit score, which dictates
Yep.
what's the interest rate that they can borrow money from. So now that airlines are struggling, rating agencies are looking at these companies and like, I don't know if I can trust you to pay your debts. So we're gonna bump you down, make you triple B instead of double B, right? Triple B is a worse rating than double B. And when that happens, imagine the airline companies want to borrow money again. Last year they were paying 5% on interest. Now they're paying 7.5% on interest. So what does that mean? They have
Just getting
more
further in debt.
exactly. So it's like a cycle. And the thing is, again, people aren't flying, right? So they're not earning enough revenues to offset the cost of the actual debt payment. So now the profits are lower, and it's just a constant cycle. And I think that's how I think, right? It's like the relationship between the balance sheet, again, looking at the liabilities, but then how do you connect that to the income statement, right? Because on the income statement, the debt payments are an expense, while the revenues is at the top of the line. So when it gets to the bottom of the line, if you see that it's declining over time, again, it's because they have more liabilities and more debts that they have to pay. So like, to me, it's all connected, but it's like it takes a while to kind of understand like the fundamentals of how does business work. And when you look at for the future, is it going to be better or worse off depending on like their financial circumstances?
That all makes sense. Cool. So that mean we ready to break one of these down? You
Yeah,
think?
for sure. Yep.
All right, you want to start with the easiest one, like, or I thought one of the easiest one, or just kind of go. I don't know if you have a list, but one of the easiest one was Raytheon, like
Yeah.
RTX.
Yep.
I'm like, thank you. That's the easy one. Like, I kind of glanced at it to be honest with you. I'm like, it's Raytheon. Like right now, defensive stocks are down, but what's going on with the U.S. and China, defense stocks are going to rise. Like, financial wise, when I looked at it, I mean, their revenue is pretty consistent, you
Hmm.
know. the net income is down a little bit, but like I said, I didn't really spend too much time on it because it's Raytheon. It's gonna bounce back. But I'll let the professional, the subject matter expert, break it down.
I mean, I wouldn't call myself a subject matter expert, but I think like focus on the balance sheet side of it. What I looked at was I just kind of put together like a quick spreadsheet and I put down, okay, what are the assets, what are the liabilities, and what's the equity? Because again, like I like to kind of look at it from a like kind of a high level and then kind of funnel down.
Okay.
So like the assets are about 140 and then their liabilities are about 100. So meaning that if I did a quick ratio, 70% of their balance sheet is the liabilities. But again, like being in that industry, you want to look at other companies and compare like are these
Right.
liability ratio and kind of in line with other companies and other sectors. To me, I don't think it's too bad just because again they're very heavily invested in like very large purchases. So again, like they're not going to have $1 billion to buy some type of defense kind of plant or something, right? So to me, I don't
Yeah.
think that's too bad. And then the other thing I looked at was the current assets and current liabilities. So when you look at the balance sheet, when they refer to current, that just means that what are the assets that within 1 year they can kind of use as money to kind of liquidate and then use to pay other things. So
Yep.
basically current assets are just any assets they have within 1 year, and then current liabilities are the same thing, any payments that they need to owe and pay back within 1 year. So the current ratio is a good way to kind of look at, do they have more assets relative to liabilities when it comes to the current ratio? And they do. I saw they have a current ratio of 1.2. So that's a good guy, meaning that, again, they can be able to kind of liquidate or kind of sell off any of the current assets soon enough that they can pay off all the current liabilities, that they shouldn't be in too much financial trouble.
So do you always use that ratio? Because like I'm glancing at it and I see, current assets, 37.5, and then I see
Yep.
current liabilities 34.5. So right there, I know they have enough assets to carry, to take care of their debt if
Yep.
needed. Can you just do that simple analysis, or you always look at the ratio?
Oh no, that's exactly, yeah, that's exactly what I did. Yep.
Okay,
And
cool.
there's different levels to it because the other thing that people look at that they like to look at is cash, because like there's this idea of when you going back to the balance sheet, right? On when you look at the assets, there's this term called liquidity, and all liquidity is just how quickly can I turn something into cash and use that cash to pay off, bills, debts, whatever. And cash is always the most liquid item. The bad thing about the more liquid something is that you don't earn anything on it, right? So for example, you and
Right,
I, we have a bank account with PNC, Wells Fargo, Bank of America, right? Where we put our cash and our savings in there, but it doesn't earn anything. Versus if you put money into stocks and bonds, they're less liquid, but they can earn, maybe 2, 3, 4, 5, 6%. But the idea is
right.
that for big corporations, cash could be another good indicator of, okay, if they have enough cash to again pay off the debts, then that's another good way to kind of think about, okay, I think even in the worst of times, they'll be able to kind of withstand like kind of tough situations if people aren't buying things, if kind of there's something going on that maybe makes like the company isn't performing as well.
Okay. So Model Petit said that's too easy. I don't know if you want to keep going on Raytheon. That is an easy one. I mean,
Yeah, we
me
can move on.
personally, like, yeah, I would just say, yeah, like you can't go wrong investing in Raytheon. And just looking at some simple things, I think it's trading at 67.27 right now. The 52-week high was like 99. So there's still some up room. It's down like most stocks because of the coronavirus. It will
Yep.
bounce back. So yeah, it's pretty safe to invest right now. Plus, they pay dividends. So any company that pay dividends usually gets thumbs up for me. Just make sure their dividends are not suspended, and I don't think it is, but I didn't do
Mm.
research ahead of time. So I don't know, Model Petit, which one you want us to go at next, or Multivision. You can just choose one if you want to.
And I think if people have questions or they want to comment anything, one thing I want to add to like another important thing that I always think about when it comes to like just debt on the balance sheet and how it relates to the income statement. And that's the thing, like in my mind, I'm always thinking about how does the income statement play and grow the balance sheet, right? Because what people don't understand is the income you generate in this period, that just flows to the equity in the next period, right? So if someone's
Right.
constantly generating revenues and income, they're increasing the equity on the balance sheet and they're decreasing the amount of liabilities that they have moving forward. But the reason why companies go bankrupt is because they have too much debt and no longer. And the thing is, when you pay your debt holders, they have to be paid first before you pay your equity holders and your dividends. So like it's
Mhm.
always important to also look at the balance sheet and understand the ratio of liability to equities, because even if you buy into a company now that is paying dividends, if they have too much debt and they get into trouble, like I think a lot of the retail stores like J.C. Penney, I think, I can't remember, I saw like a couple other companies that are kind of in trouble now. What happens is that they don't have enough money up front, i.e. profits, to pay their debt holders, like all the liabilities that they have. So they file for
Right.
bankruptcy, and that's what happened. They liquidate all the assets. They basically sell off all the assets at a discount to just pay off all the people that they owe debts to. And what happens to
Kind
us
of
is
like
when we,
Hertz.
right, again, Hertz was the one I was thinking about. And what happens for
Yeah.
people like us that we're only equity investors in the company, we don't get anything. And that's
Right.
really the thing that people have to be careful of is, oh, like this stock is trading at like a really low price. I think this is a good deal. But like sometimes the reason why it's so low is because they're struggling just to pay off their debts. People aren't believing in the stock. And at some point they go bankrupt. We don't get anything. I think that's really the only thing you need to think about, or people need to think about when investing in companies. Just understand again, like, do you feel confident that for the long term, for the future, will they always be able to pay off all the debt and liabilities and not go bankrupt? Because if they don't go bankrupt, then they continue to generate profit, generate kind of equity to increase the stock value, and then also generate equity to also send money back as dividends to the investors like us.
Fundamental analysis, man. You just broke it down. You
Yeah.
just broke it down. Like if you look at it like that, then majority of the time you can't lose. I mean, you shouldn't
Yeah.
lose. Okay. Yeah, she said she's a newbie, and the way you just explained it is like, wow. Now she see the importance of really looking at financial statements. And what on the investment side, what some people don't know is these quarterly reports and annual reports. When a
Yeah.
company goes public, they have to put this information out there. So it's not like
Yeah.
it's a secret.
Yeah.
All this information is out there for you to view. Like obviously, right now we're looking at it on Yahoo Finance. So
Yeah.
uh,
And
cool. So
and and, and,
I don't know if
and that's
go ahead.
that's what they have earnings calls, and that's so equity analysts, it's their job to dig into the numbers, dig into company financials, because really the whole point of like reporting public financials is just, are companies speaking bullshit or not, right? Because the thing is that you need to understand like how do the numbers work and do they make sense? Because like plenty of
Right.
companies, they can cook the books, they can kind of like tweak the numbers to make it look good, but like really what happens is that people behind the scenes, it's their job to analyze and say, okay, this is a buy because I believe what management is saying makes sense. Like everything they're saying, like their prospects for the future, they're going to earn more money and
Oh, yeah.
revenues and profits. It makes sense. But there are other instances where they're they're having decrease in profits, they're increasing debt, they're not making more money, they're not making more sales, but yet they're saying, "Oh, I have a positive outlook." But like something like that doesn't add up, right? So like that again, like that's why it's important to understand like fundamentals, and that's why they say like analyze businesses that you know and understand, because you're going to be more interested and you're already going to understand the industry at kind of a conceptual level.
Right, man, you just dropped so many jewels because I was thinking that that's kind of like someone just coming up to you like, hey, buy this stock, right? And you
Mm-hmm.
just take their advice and you just kind of blindly, invest. And it's supposed to, like, all right, thanks for the tip. And you go do your own fundamental research.
Yeah.
Or another example is if you just kind of like you say, listen to some of these, annual calls at some of these companies. If you just listen to it, yeah, they're gonna paint everything all rosy and
Yeah.
peachy. But then, like you say, you go look at their financial records and you look at the forward-looking statement. And it's like, hey, revenue is going to be down, profit's going to be down. It's like, hey, but at the beginning, it's like, well, yeah, you got to go and look at the numbers for yourself. It's like, yeah,
Yeah.
they just putting a lot of fluff out there, but they do
Yeah.
it all the time.
Mm-hmm. Oh yeah, for sure.
So with this knowledge, everybody can kind of break it down. So I see, I think it's Jaime joined, and I think he wanted us to look at CINF. What is that? Some type of financial company. And
Yeah.
when I glance at it, yeah,
Cincinnati Financial
yeah,
Corporation.
yeah, let's look at it. CINF. Let's break this one down. So first thing you do is go to Yahoo Finance, you type in CINF, and then what do? Just go to financials. Is that what you're using, Yahoo Finance, or are you
Yeah,
using
yeah,
something
I
else?
went to the financials. Yep.
Okay.
And
So
then
we on. Okay.
under the financials, you have the balance sheet, income statement, and cash flow. And I know like our focus right now is the balance sheet, but just to add additional context to like the income statement and the cash flow, um, and I always like this one is always hard for me to explain to people. Like if I could explain the balance sheet is kind of the today, right? How much money do they have in like their bank account? How much money do they have in their bank account? How much money do they have borrowed? and how much money they have in kind of equity. That's everything that happened today. While the income statement and cash flow, they're telling you kind of what's the pattern, what's the movement from last year to this year. So like if people want to
Oh
look
yeah.
at trends, it's important to understand like the relationship between those three, because to me, like that's like the holy trinity of business, of finance. It's just how does like the balance sheet relate to the income statement, and how does that relate to the cash flow statement? But I always like to think that the balance sheet is kind of the, like for example, if I use kind of like weight as an example, right? If I'm a healthy person, I'm going to have a strong balance sheet, meaning that I'm going to have a really good mix between liabilities and equity. And that can mean differently depending on the industry. Because again, like for example, businesses that are heavy in manufacturing that have a lot of like large asset purchases, they're going to have more liability. So something like 70% liability ratio versus 30% equity, that's reasonable. But then for other businesses where they don't need as much capital to start up, then I would expect something more like 50% or even 25% liabilities and then 75% equity. So that's like, in some sense, that's like a healthy kind of weight of the company, right? But then when you look at the income statement, you can kind of think of that as, okay, did they gain weight or did they lose weight? And how healthy was that weight that they gained? So if you look at the income statement, you want to see a lot of profit that, again, is going back into the business, because really the idea is that for businesses to grow, they need to constantly innovate. And for them to innovate and sell more products and grow, they need to generate profit. And that's just reinvesting the profit back into the business. And
Right.
and I think
Okay.
that was like a real, that was the reason why so many people kind of had issues with the airline industry, is that they haven't really been innovating. If anything, they're just charging us more to get a seat, use the bathroom. Like
Right.
they haven't been innovating. They've only been charging increasing prices to stay relevant. But they're still doing like share buybacks and a lot of things. And again, it depends on the person if they think it's good or not for the business. But at the end of the day, like I think that drives the reason why a lot of them are struggling right now, because to to them, they haven't really been using their cash and profits wisely to kind of reinvest back into the business. But that's just like an example of like, again,
Okay.
how the balance sheet is related to the income.
Why am I? Um, I don't know if that was my connection or your. All right, cool. Now we're back.
Mhm.
Yeah, everybody's from home, man. Like my connection goes in and out sometimes, but
Yeah, I've been having issues too. I don't know if do you have Verizon? My thing's been acting up too.
Spectrum.
Oh, okay.
Yeah, same thing.
Um,
Cool. All right. So what were we on? Like, so you were discussing the balance sheet. I like that analogy, like the weight, and like the way you broke it down, like it makes sense. And then you went on to the income statement. So am I gaining weight or am I losing weight? And
right, right.
then I guess you're transitioning to the cash flow.
Yep. And really the most important thing about the cash flow statement is that it's similar to the income statement, where that's like a moving target where, again, are you gaining weight? Are you losing weight when it comes to cash? And actually, the whole idea of the cash flow statement just tells you how much your cash moved on the balance sheet, on the asset side of the balance sheet, from like quarter to quarter or year to year. Um, and also there's like a relationship between the income statement and cash flow statement, but that's like getting like in the weeds. I don't think people really need to know right now. I mean, they can do the research, and I think it is helpful, but I think for like analyzing kind of companies in general, I think you can kind of stick to the balance sheet and income statement for the most part.
Okay. So right now we're looking at what CINF, right? So we're
Yep.
gonna break that down for Jaime. All right. So I'm guessing you're starting with the balance sheet.
Yep. So when I
All right.
pulled it up, I saw it had about 20, and I think this is in um, billions. I think it's 23 billion in
Yep.
assets and then 15 billion in liabilities. So then the first thing I looked at was, okay, the liability ratio itself is about 66%. So they have about 2/3 in liabilities. Um, Another ratio that people look at is debt to equity. So while the liability represents the total thing that they own in the future, the debt represents like the real kind of money that they borrowed for that company. So then the debt to equity ratio, just looking at on the right side of the balance sheet, what's the ratio of kind of the money that they borrowed versus the money that they have in ownership or that they have from equity investors themselves. And with the debt to equity of 0.12, that just means that they actually
Well,
have more equity than debt, which I think is a good thing.
okay. So a debt to equity ratio of say 0.12 or 12? No, 12.
Yeah, and in their analysis, I think they multiply by 100.
So is it true like anything less than a one is bad, right? So anything greater than one is good, or when we're talking about debt to equity ratio?
Yeah, in this case, since they multiply by 100, I think anything. Yeah, because basically it's just the debt divided by equity. So yeah, the lower the number, the better, because that means that they have more equity than debt. But again, I would say like comparing it within the industry, for example, this is a bank, right? Cincinnati Financial Corporation. You want to look at other financial corporations in the same niche, same sector, and see, okay,
Right.
what is their debt to equity and how are they using their debt to again finance their business? Because really the whole point of even borrowing money in the first place is just, okay, let's say I have a project that's going to cost me $100,000. Even if I had that money like in my bank account, it doesn't make sense for me to drain all my funds out of my bank account just
Nope.
to invest in that project. Because if I lose everything, the like I don't have any money, I don't have any savings, and then the project is also done. So instead, people will borrow money. Maybe they'll borrow 80,000, and then they'll put in 20,000 of their own. So the idea is that the project itself should be generating more revenue and profit to then pay back the debt payments over time. And that again goes back to my idea of the relationship between the balance sheet and the income statement, where if you believe that companies have good ideas and have good products and projects that for the long run are always going to be around, then if they like borrow money but can always pay it back, then I don't really have a problem with it. I think it's more when the company product is shit, like people aren't buying any more of it, they have a lot of debt, and like they're not able to kind of like generate enough profit to pay back that debt, then I think
Right.
that's when it's a problem where it's like I don't know if I can really trust that company to remain like sustainable enough, long enough that their stock price is going to continue going up.
Cool. So we got a question here about equity. Do you mean stockholder equity?
Yes. So, yeah, when I say equity, I mean stockholders' equity. The important thing to know that equity, like by itself, is kind of the aggregate amount of equity on the balance sheet. Because when you look at the balance sheet, it's three main parts. You have the assets and then the
Hmm.
liabilities. When you subtract the liabilities from the assets, the remaining portion of the equity. Now, when people like us, when we invest in companies, our portion is a very small piece of actually the total equity. There's other thing called retained earnings, where the
Right.
retained earnings is just the accumulated profits over time that again the business itself has generated that stays within the business. But then you have like kind of equity from like other kind of big financial corporations, and again, like you can use the equity in different ways. You can either pay back dividends, you can send it back into the company to reinvest in other projects. Like there's many different ways you can use it. But yeah, when I say equity, it's the same as stockholders' equity.
And I just learned some retained earnings. I was actually looking at today when I was doing some research, and I kind of assumed, what it meant, but like, yeah, I'm glad you explained it. So now I know exactly what it
Yeah.
means.
And I
Cool.
think I think that's a powerful measure because again, it just shows like if retained earning is going up, that means
Hmm.
that the company is consistently generating profits and putting it back into the business. Now, how they use that money, it depends again on their strategy. If they think that they want to hold tight now because COVID hit and like let me just hold my money, stay safe, be able to like pay all my employees, then I think that's a smart way to go about it. And then once all this is over, let's say like they use that money to, for example, Spotify just had that deal with I think it's Joe Rogan
Yeah, Joe
for the
Rogan.
podcast deal, right? A hundred
Yeah,
million is a lot of money, but
crazy.
like to them, that's an investment, right? Companies make
Yep.
investments, and for us as that's why the stock price went up because people believe that for the long run, this is going to position Spotify to be playing with YouTube, to be playing with like the big players that maybe they may take over some market, and if they can take over that market, then the value of the company is going to go up. So then the stock price is also going to go up. So just like again, like understanding like the business piece, I think is important. That I think a lot of people forget, where they just think like, oh, like Amazon is like $1,000. Like, let me get into Amazon now while I still can. But like, it's
Thank
like
you.
it's like ignore the hype and really try to understand like what are the business fundamentals, like how the business going to make money for the long term. Then like if you understand that piece, then it's very difficult for you to kind of go wrong.
That's one of the first things we talk about when it comes to investing. Before I even start breaking it down, I said, look, one of the most important things you're gonna have to learn is to control your emotions.
Mm-hmm.
Control your emotions. If you can't control your emotions investing, then yeah, you're pretty much done for. Because, like you say, everybody's saying, oh, like Tesla, when it was shooting up to 900, $1,000, people are like, oh, I gotta invest in it. Like, the fear of missing out. It's like,
Yep.
no, it's not. It's not worth that. and unfortunately, a lot of people got caught holding the bag and lost a lot
Yeah.
of money. So
Yep.
emotions is very important. All right, so are we still on CNINF or yeah? We're on the balance sheet or the income sheet. So I know we were looking at assets.
Yep.
They're like 25 billion, liabilities 15 billion. All right.
Yep.
All right.
And I guess what's your process when you kind of go through companies and analyzing stocks?
So I mainly do technical analysis. So I kind
Okay.
of, I kind of like look at like some of the ticks, is it trending up? Is it trending down? So like, a quick technical analysis when I look at CINF, first thing I'm gonna look at is like, all right, what's the 52-week high? And
Yep.
I see it's at 118. It's like, all right, cool. It's trading at $60 right now. Why is it trading at half its 52-week high? Obviously right now, majority of the stocks are down for COVID-19. So,
Yep.
so I wonder if that plays a factor. So then I go look at the 5-day chart and I see that it's trending up, So, all right, well, cool. It's trending up the last 5 days. Then I look at the 1 month chart. When I look at the 1 month chart, it's kind of like a V. And like they say, at one point they thought the recovery was gonna be like a V. So it kind of makes sense, within the last month, it's kind of like a V. It
Yeah.
went down and now it's kind of like trending back up. And then I look at the 6 month, and the 6 month, yeah, it's down, but I see that it took a real nosedive around what, February 27th, right around March, right when all the chaos was kind of happening and majority of the stocks kind of took a nosedive.
Yeah.
And when you look at these, I look at all these stocks that all our followers kind of recommended us to look at. You'll notice like most of the charts are very, very similar, you
Yep.
know.
Yeah.
So that'll tell you like, okay, most of these stocks, that'll give you a good indication. Like, is my stock really down because, bad financials, or is it down strictly because, the whole market is
Yep.
down as a whole?
Yeah.
And so with this one, yeah, just looking at the charts and like, it's looking like all the other charts,
Yep.
So that's just a quick way of looking at it. And then of course, I always look at dividends. If it pays dividend, that gives it a thumbs up. But then I have to go research and look at the history. Like, are they consistent with paying dividends? Or not only are they consistent, have they been increasing their dividend
Yeah.
payments as well?
Yeah.
But, and this is another subject, but I normally invest in stocks who've been paying dividends for 25 years
Yeah.
plus, the whole dividends, aristocrat list and stuff like that. So
Yeah.
that's how I break it down.
Okay. And then there's a question from Jay and Bloom. Why do you pinpoint at 52 weeks? So one thing, I'll let you answer that, but one thing I'll just touch on is we talk about fundamental analysis and technical analysis. So like in investing in general, there's kind of two ways of you can invest, or two ways you can kind of analyze companies and stocks. Fundamental analysis is kind of what I've been saying, where you go to the fundamentals, you go to the numbers on the balance sheet, the income statement. Basically, what is the company reporting to the public? While technical analysis is really looking at like patterns and trends and see if those patterns and trends continue to kind of persist in the future. And what he was saying was just that if even though like this company, Cincinnati Financial Corporation, is going down, majority of other companies are kind of following the same trend. So that's more of a market risk, where the market itself is kind of going down, right? That's due to COVID.
Right.
It's not like it's something that's intrinsic to the company itself that is suffering. So like that's kind of what he was saying. But I'll let you kind of speak to why you focus on 52 weeks.
Yeah, the 52 weeks, I mean, everything that you said, and it's just a quick snapshot. It's like, okay, what has it been doing in the last year? And so
Yeah.
I see at one point it traded as high as $118. And so the quick, simple question is, okay, can it get back there? And if it can, then you pretty much double your money.
Mhm.
That's just a simple way of looking at it.
Yeah.
Very simple way. And so another thing, I always look at the 1 year target estimate. So, this stock, obviously some analysts have looked at it and took their time and broke it down. A lot of these estimates are very, very close,
Mhm.
and that can kind of give you some type of indication. If all the analysts think, hey, and within a year it's going to be trading at $75, and right now it's currently trading at 60, then hey, you see there's some upside. So,
Yeah.
all right, what are they saying here?
So technical helps you understand the landscape. Yeah, I'll say it helps you understand kind of really just how's it been moving in the last week, month, 6 months, year. And because what a lot of people do, especially when you kind of get into statistics, sometimes people will try to see, okay, can I predict what it's going to be doing over the next month, next 6 months, next 12 months? But yeah, I'll say fundamentals is kind of more diving deep into the financials of the company itself.
Well, yeah, like and it also depends on your flavor. Like some people like to stick with fundamental, some people like technical. In theory, technical is like, hey, everything that you're looking at fundamentally, I could look at by looking at what they call like candlesticks, you know,
Yeah.
and I could just do a technical analysis off of that. I don't have to go deep dive into the financials. And even though we're looking at patterns and we're looking at trends, one thing you have to remember is patterns tend to repeat, but they don't have to. And
Yep.
so a lot of times they do. You see a pattern like, oh, I know the stock is going up. And it's a good 70% chance you're going to be right. Sometimes you're going to be wrong. But overall, if you got a 70% chance, you're pretty much going to make a gain. So that's kind of how I look at it.
Yeah.
That's why I like technical analysis.
Yep. And when you do that, that's why it's important to have diversification, because the idea is if one stock goes down, hopefully you have another kind of investment that moves in the opposite direction where it goes up at the same time. That way you're smoothing kind of the losses and gains, and that it kind of smooths over time. So
Yep.
that's a valid diversification. That's why I just do index funds, just because they already do the work for me, and I just put my money in, I just let it sit.
Oh, I got index funds. You know, I still pick individual stocks, but
Yeah, yep.
you know, like my family members say, hey, what should I invest in? Index fund. All right,
Yeah.
what else? Index fund. What else? Index fund. That's the answer.
Yeah.
Don't take a risk. You don't know what you're doing. Index fund.
Yeah.
So cool. I don't know if you got anything else on CINF. I don't know if we want to give it a thumbs up, down, or you want to break down the cash flow. Let me look. So I already know you already have a spreadsheet. I kind of just took mental notes. That's like a bad habit, like Lil Wayne. I just take mental notes.
Just spit off the dome.
Yeah. So with theirs,
Just,
are you looking at the annual or the quarterly? Because the annual look okay, but when you dive into the quarterly, it's like, man, these guys are running out of cash.
yeah, so I'm actually looking at the quarterly now. Let's see. So okay, so just to let everybody know what we're looking at now. So again, we're on Yahoo Finance, just putting up their financials, and really what we like to do is we like to look at trends, right? We want to see, okay, if they had, so right now we see that their ending cash position, as of this past March, was about 500 million, but last December it was at 750 million. It was
Yep.
780 before that, then 800. So like they're kind of having a declining cash position. So like you want to kind of be a detective to see, okay, why is their cash declining? Are they paying off debts? Or are they kind of use that money to reinvest in elsewhere? And obviously we can't see that right now just because that'll take more time. But again, it's like when you're doing this type of analysis, always kind of take the time to understand the why. Like if something's going up, understand like, okay, revenues are going up because they're making more sales. Why are they making more sales? Because people believe,
Yeah.
again, that this is a new product that's going to be on the up and up. Then I think that's a good investment. Versus if things are going down, it's important to understand why it's going down.
So this is definitely going down. Like you say, maybe you have to take a deeper dive and like, why exactly is this going down? Like
the one thing I noticed is that as of March 2020, the financing cash flow is 300,000, but then as of December 2019, it was 300 million this March, and it was 200 million last December. So this was money that they paid out in financing. So again, that could maybe be due to like a share buyback or something where like they're using the money in the form of like related to either like issuing dividends or something. So that's just something to think about.
oh, I didn't know that one. Okay, I see it, but didn't know what it really meant.
Mm.
What about this in cash position?
Yeah,
Like,
so the end cash position, really what that's saying is that's how much at the end of the day they were still able to generate basically $500 million of cash from December to March. And what I was saying before is the way this relates to the balance sheet is that if you take two balance sheets, right? If you take the balance sheet from last December and the balance sheet from this March, and you take the difference in the cash, that's going to tie back to the end cash position on the cash flow statement. And again, like that's just the way I think of like, how do I connect the dots? How do I connect the balance sheets, which kind of like two pillars, and then between the balance sheets is the income statement, where it's relating like the net income to the equity, or it's the cash flow statement, which is relating the cash position to the actual cash on the balance sheet.
okay, cool. So you see any red flags? Any good signs?
And the free cash flow is going down too.
Yeah, I see that. 163 million.
And the only reason I look at free cash flow because that's kind of the free money that the company itself can use to again invest in projects. Like when I talk about like reinvesting back into the business, that item right there, that's the real amount of cash that they can say, okay, after we've made our profit and paid all of our bills, did everything we had to do. This is kind of the play money we have that we can kind of play around with and move forward. So like that's another metric that I think like a lot of people that look at kind of forward looking kind of analysis to say, okay, what's that like? How much can I expect it's going to grow in the future based off some project? Free cash flow is a good metric for that.
Okay. All right. How many got a question?
Mm-hmm. So is there something in the financial that starts to become a red flag to pay attention to? So again, it depends, right? So I think the first thing is you want to always look at things relatively. Like you want to compare. For example, we're looking at Cincinnati Financial Corporation. So you want to compare that to other financial corporations that have a very similar business model and say, are their sales in line? Are their profit margins in line? All profit margin is just it tells you how much net income, how much money are they generating based off of their sales. Because at the end of the day, like sales are nice, but the real money is actually the profit, the net income. It's the
Right.
same how we get gross income, but we have to pay taxes, we have to pay for healthcare. We can only use our net income to pay our bills, pay our rent. The same thing for companies, right? So like
Yep.
things like that, profitability measures are a good measure to compare against, and even like return on equity is another measure that you can kind of use as another metric to see are they really using our investors' money wisely to again grow the business further.
All right. So from the technical side, like I say, just glancing at the financials, and I don't know too much about breaking it down like you.
Mhm.
I probably wouldn't just invest in this, to be honest with you.
Yeah.
Not right now. I'll
Yeah.
probably hold off, and I'll probably hold off to the next quarterly report. I'm very interested in seeing the next quarterly report before I
Yeah.
would make a decision to invest in it or not. Because the last quarterly report doesn't look that good. Actually, the last two.
Mhm. Yeah, I think just
So
take, and that's the thing is like, people are like, people are worried like, oh, I don't want to miss out, but it's like the stock isn't going anywhere. Like, be patient. Like,
no.
I think it's important because like, at the end of the day, it's like, again, this is a long-term game. There's always going to be investments that you can put in money now that 30, 40, 50 years down the line, there's still going to be a good investment. So I agree that, take your time and don't feel too pressured to invest.
All right, cool. All right. So I don't
Actually,
know if yeah, anytime. I don't go ahead.
can we do internet the international I think continental hotels because
Yeah, definitely do that one. I was gonna ask you, you want to just do one last one? We had two choices, so I don't
yeah
know if anybody online had it one they wanted to break down, but yeah, go ahead.
yeah, and the reason why I want to go to this one is because when I went to their financials, and obviously again because of COVID, right? Um, the hotel industry is kind of suffering right now. But the one thing that stuck out to me is when I went to the financials, again, this is on Yahoo Finance, and I went to their quarterly balance sheet, I
Okay.
noticed that they have negative equity. So, so I'm looking at the balance sheet, and I can only see, yeah, I can only see December and June for whatever reason on Yahoo. But basically, when I'm looking at it, the total assets are, I believe, what 4 billion, right? But then the
Yep.
total liabilities is almost 5.5 billion. So to me, that's a huge red flag, right? Because
Oh yeah,
what
I
we're
see that.
saying, and again, this kind of goes back to what I was saying about you can be a millionaire but still be poor. In this
Yeah.
sense, we're saying that the assets are one number, but then they have more in debt and money borrowed. And to me, that's a big red flag, meaning that they owe more to people than they're going to be bringing back in value. Um, so I now again, like it depends if you look at other companies in the hotel industry. If that's consistent, then maybe you can reason it. But even still, like another thing is like this is before like COVID was even a thing. So it's like if we're saying that they have a negative equity, i.e., negative net worth now, who knows what their March financials would even look like?
All right. Yeah, they don't. They haven't even. I mean, Yahoo didn't publish their March quarterly
Yeah,
report. So let me ask you. All right. So when you just glance at this, like just a quick analysis, like wow, they have more liabilities than assets. Do you
yep.
even move on? Is it even worth moving on, or are you just like,
I guess it depends and this is getting like really in the weeds. So like when I look at this, I went down. I just checked the total debt is 2.8 billion. And again, the
Right.
total assets is 3.9 billion. So that means that the total money borrowed is still lower because like liabilities can be more than just like loans and money that you borrow. But again, like just the fact that you owe so much money is already the first red flag. Then like we're saying, okay, the total debt is 2.8 billion relative to the total assets about 4 billion. That's still pretty high. And when I looked at their debt to equity, I did the ratio earlier. Oh yeah, that's the thing. It doesn't make sense just because again the equity is negative, right? So
Yeah.
that's
So
another red flag. The cash they have about I think it's one. Oh no, they have. Let's see. Yeah, they have about 200 million in cash. So like if it was me, and again, especially if I'm not already in like the hotel industry, I'll be like, it's not even worth my time to dig deeper. But if you understand the hotel industry really well, and again, you're looking at other kind of comparatives, and you see, okay, this is more of an industry thing where for whatever reason they borrow a lot of money up front in order to maybe build a lot of new hotels in like new markets like Africa or Asia or whatever, right? That could be one. That could be one reason as to why we see this negative net worth right now, this negative equity now. But if you look at like the trend for the long term, like let's say I'm able to look at the trend for the last 2-3 years, and it's only been getting worse and worse, then to me that's definitely a red flag, and I'll say I'll just stop right there.
So I don't know if this company has done it, but a lot of time when the companies are, in a lot of debt and they need to raise money, they would do an S3. So I don't know if people are familiar with that. You go to sec.gov or
Mm-hmm.
sec.egert. And if you see an S3, that means they're going to do a public offering. So sometimes you might see a stock like go all the way up. It's like the pump and dump. People have heard about that. It's like, why is this stock going up? There's no news. Well, behind the scenes, they're just putting out more shares, diluting their shares, and they sell these shares, and people buy them at the top price, and they get caught holding it, and then the stock price dips, and they keep the money to kind of grow their company or finance their company. So you got to be kind of careful of that because I see it all the time doing day trades. So watch out for those S3 offerings or public offerings.
Okay.
And
And
they do it
actually,
in sneaky ways, man. Sometimes they'll do a public offering, and the prospectus won't come out for 2 or 3 months or a couple of months, and so they have the right to do a public offering like whenever they want to.
mhm.
So they might do it a year from now or 2 years from now. So that's just on the investment side.
Yeah. And I know we only have 8 minutes, but real quick, so actually I just checked Marriott Hotel just because I wanted to see a comparison. So the one thing is that they're a much bigger company, right? Because we're looking at Intercontinental Hotels. They had assets of 4 billion, while Marriott is 26 billion. So they're a much bigger company. Um,
All right,
but
let me
the
see.
interesting thing is, as of this past March, they do have a negative equity of 20 million. So it's a similar thing where their liabilities are now more than the assets. But that wasn't always the case. This is the first time, at least in the last year, that this has happened that I can tell just by looking at the financials. So again, to me, this I think is driven by COVID, right? They didn't make
Okay.
revenues, they didn't generate profits. Again, go back to the business. So like basically like their debts are kind of getting bigger than the equity that they have on their balance sheet. But again, like compared to what we saw at Intercontinental is still way worse when it comes to like looking at their balance sheet health. So I would definitely say just looking at the quick comparison that I don't think the Intercontinental would be a good idea at this point.
Okay, yeah, I have to bring up the Marriott stock. So do you just bring them up side by side like on Yahoo Finance, or you actually go to one site that kind of do a
I just opened up
comparison?
another tab. Yeah. Mm.
Oh, you got another tab? Okay, yeah. That's why I'm just going back and forth trying to compare the two. Pretty sure you got some type of spreadsheet that you kind of throw all
Yeah.
these numbers into. Yeah. That's what I got to work on my spreadsheet. I actually got one. I just haven't finished it yet.
Mhm. And that's just because like I'm a very numbers driven person with like I like to use ratios and like because I like to compare. Like it makes it a lot easier to say, okay, this one is better than this one because I can see like the ratio is good or the ratio is bad. And but everyone had like their own style. So I think it's just find what like someone is comfortable with.
So speaking of like spreadsheets, like it's easy to like develop like a spreadsheet with the formulas already put in there, and anytime you want to do analysis, you just copy these numbers and throw it in there,
Yep.
and there you go.
Yeah.
I don't think people realize how simple that is. Like,
Yeah. No, I definitely
cool,
agree.
cool. All right, cool. All right. You know what? My battery's getting low, so I'll let you take it for 1 second. I gotta get my charger. Sorry, I didn't charge my phone fully.
I don't know if people have questions.
Now, let me see. We still got a decent amount of people online, so
Yeah.
we're kind of running out. out of time. So if anybody got any questions, whether it's on the investment side or on the business sides, because you
Yeah.
know, like you said, you know, you can use liabilities for more than just on the investment. You use it for personal and business as
Yep.
well. If anybody want us to review a stock or got any questions, now's the time.
I think one thing that I think really is really helpful for like understand like just the basics of finance is just that, because really like corporate finance, the whole idea is basically how to use how to use debt or how to use equity to grow something, right? It's just how to use money to be strategic with things. Like that's why I always like to look at the balance sheet and understand like really how they're using liabilities, how they borrowing money, how they're using like their equity value to grow the business and push it further to how they generate more profit or figure out a way to kind of just be more valuable than the competition. And I think that to me personally, that relates a lot to entrepreneurship because that's where I'm trying to go. That's where my interests lie. Because I'm very more interested in investing like small businesses. But again, you can like apply this to like big businesses, small businesses, or even yourself with personal finance.
Right. We got a question.
I think so. This is how can international person invest in U.S. stock market? I don't know if you know, but I think it's just you would have to open an account. But I think there may be restrictions depending on
It's
like
probably going to be some restrictions, to be honest with you. I asked my mentor because I think he discussed this before, but it's probably definitely going to be some restrictions. But if you can't invest directly, I'm pretty sure there's some ETFs out there for like emerging markets or something like that, or some type of index fund where you can invest in and get exposure to like American companies.
Yeah, that's a very good point. Yep.
Yeah.
And yeah,
Yeah.
we'll definitely save this. Yep.
Yeah, it's definitely going to be safe. Yep. True. And to be honest with you, my vision, I know like, you know, you got a job, I got a job, time is kind of, you know, but like with Miami Invest Club, I was thinking about, you know, Dividend Tuesday, and with you like break it down Thursdays, like, you know, whenever we're available, once a week, twice a week, once a month, whenever. And we're going to keep doing these. So, you know, if you got any companies you want us to look at in the future, like, you know, go to my page, go to Multivision page, leave a
Okay.
comment. And yeah, eventually we'll get to it.
Yeah, just love
Or any business questions. You try to start a business and you got some questions, definitely,
yeah.
you know, go to Multivision.
Yep. Nah, I definitely appreciate, you know, everyone taking the time. Yep.
Yeah, all right. Well, I guess we're just gonna wrap it up, man. Obviously, I appreciate everything. I'm gonna save this. For some reason, whenever I try to put a cover on it, it don't save. So I'm
Okay,
just
yeah.
gonna say, yeah. Just I don't know why. It just never works. It's kind of frustrating, but
Yeah, Instagram is always acting up with some bullshit.
yeah, it's always something, man. Like they're not making it easy for us. Like
Yeah.
even Facebook, it's like always a challenge, man. Why can't I share my screen? Why can't I do this? It's just
Yeah.
and they did some upgrade now where my camera doesn't even work when I go live, so I always have to do it on my phone. But
Okay.
whatever. But anyway, we're gonna save this video. We're gonna post it. I don't know if you got any last things you want to throw out there about I don't know, your page or anything.
I guess just one real quick. So I'm actually working on a template right now to help people understand like loans, like mortgage, student loans. So basically, it's the idea of like when you borrow debt, you pay a lot of interest on the debt, and I don't think people really can see the number itself. So I'm working on like some type of just a quick spreadsheet tool. It'll be for free. Just have to drop your email, and hopefully I can get that out in the next week or so. So definitely, you know, stay tuned to see something like that because I think whether or not you're starting your business, trying to buy a house, paying student loans, I think it's just a good tool to better understand, you know, how much interest and debt do you have on your balance sheet.
Cool. Whenever you finish it, you know, shoot it to me. You know, I promote it. I throw it in my Facebook group. Yeah. So cool.
Okay, cool.
All right, brother. That's it. Thanks everybody for joining, and yeah, thank you as well. And yeah, we'll talk soon.
All right, thanks, man.
All right.